What are CLO managers trying to do? How are these fights getting more bitter?
That's an interesting thing about this default cycle is that we're having some of the most bruising battles between lenders as they restructure companies that fall into stress, usually because they've been profoundly impacted by COVID. And CLOs have traditionally handcuffed themselves willingly in distressed situations because they wanted to make sure that note holders and people who invested in them felt very safe, that they wouldn't do really extraordinarily risky stuff in the recovery. Well, hedge funds have started taking advantage of those limitations. And the CLO world has woken up to the fact that this is going to be a really bruising battle. Hedge funds are going to take advantage of them. So what can they do to fight back? There are limitations that they can do, but one of the things that they're doing right now is to amend old CLOs so that investors can put fresh cash. And fresh cash is the biggest tool in a restructuring. That gives you the ability to fight back and participate in the various auctions that a company wants to do to get out of trouble.
We showed that chart, which is amazing, of the expected defaults of leveraged loans. And, obviously this could be very tied to the pandemic. But just in terms of the terms that are trying to be changed here and the lack of flexibility here, how much of this is a surprise to the players that are involved?
Well, they always knew they had limitations, but it was what I think surprised people is that hedge funds would try to take advantage of them because they've had these limitations for a long time. And in previous cycles, they haven't been as much a target. I think two things that's really changed is that the leveraged loan market and CLOs have just grown, so they're a bigger target. And also something that we've discussed quite a bit is how awful the covenants and documentations in leveraged loans have become in the past decade. And so with these very loose documentations, hedge funds can come in, distressed guys can come in and really preference one group of lenders and profit over other lenders than they could previously. So after having woken up pretty much this year saying, look, we're a bullseye target right now, we need to fix this, they're trying in various ways. And they've been having limited success so far, but they're definitely trying.
So just in terms of what you think the options are for the players in this market, we saw that percentage of potential default here. How destabilizing is that rate of default for the investors here, for the CLO market?
So that's a lot. It's a huge default rate. And so there's a lot of equity investors and people who are holding the lower rated debt will feel some pain, quite a bit of pain. There's already been pain, and it will just get worse as the default cycle picks up and more companies go default and go bankrupt. But so how much they can recover when these companies default matters quite a bit. And that will depend on how willing and able they are to fight against these hedge fund maneuvers. Because if hedge funds disadvantage CLOs end up 20 to 30 cents lower recovery, that's going to really be painful.